Picture this. You check your savings account. The number is the same as yesterday. It didn't go down, so it feels safe, right? But in reality, a chunk of that money is vanishing every single day. This isn't some conspiracy theory. It's a basic part of how our economy works. It's called the inflation tax, and it's how your hard-earned savings are silently turned into government revenue. It's so sneaky, so baked into the system that most people never see it. In this video, we're going to break down exactly how this silent thief works and show you why the money you think is safe is losing value day by day. Okay, so inflation. Most people think it's just prices going up. Gas, groceries, rent, everything gets more expensive and your paycheck doesn't go as far. But that's just a symptom. Here's the deal. Inflation isn't about prices rising, it's about the value of your money falling. Every dollar you have is a tiny claim on all the stuff in the world. When the value of that dollar drops, you need more of them to buy the same things. Imagine your savings account is a melting ice cube. You're not touching it, you're just keeping it for later, but it's slowly turning into a puddle all on its own. After a week, a month, a year, you look and realize a big piece of it is just gone. This is exactly what inflation does to your cash. The annual inflation rate for the US was 2.7% for the 12 months ending in December. This means that the $100 you had a year ago now only buys what about $97.30 could buy back then. Those $2.70 didn't just disappear, they were transferred. This is the inflation tax. It's a tax you pay just for holding money. And unlike other taxes, there's no vote, no debate. It just happens all the time to anyone holding cash. This idea of a government messing with its own money to pay its bills isn't new. In fact, it's a story that's been playing out for thousands of years. To get how it works now, we have to go back to ancient Rome. The Romans had a silver coin called the denarius. It was like the dollar of its day, trusted because it was made of real, pure silver. But emperors have expensive habits: wars, building monuments, and keeping everyone happy. When taxes weren't enough, they got clever. Starting with Emperor Nero, the government started melting down the pure silver coins, mixing in cheap metals like copper, and then making more coins out of the diluted metal. At first, nobody noticed. A denarius still looked like a denarius, but people caught on. They realized the new coins had less silver. This led to something called Gresham's Law. Bad money drives out good. Basically, people would hoard the old valuable silver coins and spend the new crappy ones as fast as possible. Why spend a good coin when the government would take a diluted one for the same price? Over time, this got out of control, and by the end of the 3rd century, the denarius had almost no silver in it at all. Now, Roman hyperinflation was complicated, but this was a huge part of it. They needed to pay soldiers, so they diluted the money. It was a slow transfer of wealth from the people to the government. This old playbook hasn't been forgotten. It's just been modernized. So how does this work in our world of digital dollars? Today, the government doesn't have to mess with physical coins. The process is way more sophisticated, but the result is the same. The modern version is run by central banks, like the US Federal Reserve. When the government wants to spend more money than it gets from taxes, which is pretty much always, it issues debt called government bonds. In the past, they had to find real people to buy these bonds, but now the central bank can just step in and buy them. Where does the central bank get the money? It just creates it. Poof! With a few keystrokes, new digital dollars appear in the government's account. This is often called quantitative easing. This whole process of creating money to fund the government's spending is a type of revenue called seigniorage. Historically, it was the profit a lord or seigneur made from minting coins. Today, it's the revenue the government gets from creating money. The government gets to spend this new money first at its current value, before it starts circulating and pushing up prices. As that new money floods the economy, you have more dollars chasing the same amount of stuff, which makes your dollars worth less. Your slice of the pie gets smaller because they just added more slices without making the pie any bigger. While the Fed says it aims for 2% inflation, recent years show they're willing to let it run higher to meet their goals. That target is basically an admission that a slow, steady draining of your savings isn't a bug, it's official policy. But it gets worse. The inflation tax also teams up with the regular tax system to hit you with a 1-2 punch. The first hit is bracket creep. Imagine you get a 5% raise, you feel great. Then you realize inflation was also 5%. In real terms, you didn't actually make more money. Your purchasing power is exactly the same. But the tax system only sees your nominal income, the bigger number. That raise could be just enough to push you into a higher tax bracket, making you pay a bigger chunk of your income in taxes, even though you're no better off. Now, to be fair, the US tax code has been updated to help with this. Tax brackets and deductions are now adjusted for inflation each year. For example, for tax year 2026, the standard deduction for a single person is set to rise to $16,100, and the 12% bracket will go up to $50,400 to prevent this. But here's the second hit, and it's more subtle: the tax on phantom gains. While income tax brackets are adjusted for inflation, the rules for capital gains taxes are not. Imagine you buy a stock for $100. A year later, you sell it for $105. The tax code says you have a $5 capital gain, but what if during that year inflation was 5%? Your $105 today only has the purchasing power that $100 did a year ago. In real terms, you made no profit. You broke even. Yet you still have to pay capital gains tax on that $5 phantom gain. You're literally paying taxes on inflation itself. How cool! This applies to stocks, real estate, and anything where your gain is measured in dollars. I get that this can be frustrating. It feels like the system is rigged, but understanding how the game works is the first step to playing it right. So, what's the hack? If holding cash is a guaranteed loss, the answer is simple. Don't hold more cash than you absolutely need. The key is to turn your depreciating money into assets that can hold their value or even grow. You have to become an owner, not just a saver. This means investing. Historically, things like stocks give you returns that beat inflation over the long haul. When you own a piece of a company, you own its future earnings, which tend to rise with inflation. As the company charges more for its products, its revenue grows, and so does the value of your slice. Another one is real assets. This is stuff like real estate. A house is a physical thing whose price tends to rise when the cost of everything else does. Even debt used strategically can be a tool. If you have a fixed-rate loan, like a 30-year mortgage, and inflation goes up, you get to pay it back with future dollars that are worth less than the ones you borrowed. In that case, inflation actually works for you. The specific strategies are a big topic for another video, but the main idea is universal. You have to move your money from things that are guaranteed to leak into things that have a chance to grow. The financial world is governed by hidden rules and silent mechanisms just like this one. The game is rigged, but if you learn the rules, you can rig it back. If you want to keep learning how this system really works to protect your future, make sure you subscribe and hit the notification bell. We're just getting started. That number in your bank account, it's not a fixed measure of your wealth. Now you know the truth. That number is a moving target, constantly getting worn down by the inflation tax. And now you know this isn't a bug in the system. It's a feature. It's a way for governments to generate revenue that has been used for centuries. Your money isn't safe just sitting there. It's a melting ice cube. But knowing that isn't a reason to give up. It's a call to action. By understanding the hidden leak, you've gained the most important tool to protect yourself. You can see the problem, and now you know you need a better bucket.